In this presentation, we will continue on with part 2 of our example problem related to a public university, continuing on with recording transactions. Here's going to be our information up top. We're going to journalize that journal entries down below. Then we're going to post those journal entries to our trial balance worksheet. The trial balance worksheet being in order with the assets up top in green, liabilities in orange. What would be the equity section in a for-profit organization? Here, net position section in the public university in light blue. Then we have what would be the income statement type numbers, those temporary type numbers, the revenue and expense type numbers in the dark blue. First transaction says general expenses related to administration and operating of academic programs is going to be the $3,245,000. We're going to record these transactions basically as if we're recording all the transactions in a group transaction, all like transaction, the activity for the entire period here, as opposed to recording a bunch of smaller transactions during the period. That'll give us an idea of the types of transactions that are going to be involved, as well as allow us to concentrate in on those sections that would be different from a public university to other types of for-profit types of organizations. So this will simply debit the expense account for the general expenses for the $3,245,000. Then we have the research expenses related to the development of student performance, the $27,000. We will then debit the expenses related to research for that $27,000. We're going to assume these transactions will be on account. So we're going to record these on account, meaning we're not going to be paying cash for them at the point in time we're recording them here. We're going to put them into a liability account, that being accounts payable, liability account, accounts payable, credit balance. It goes up in the credit direction. Recording this out then will look like this. We have the general and the research expenses increasing the expense accounts on what would be similar to the income statement. We will be crediting the accounts payable, increasing the liability account in the credit direction. We could see the effect on what would be similar to the net income would of course be decreasing it because the expense went up, bringing what would be the net income going down. That's going to be the sum of all of the dark blue type numbers, and that's going to be the credits minus the debits. The credit balance here does not mean a loss, it means income. Next transaction, we're going to take a look at this accounts payable at the year end. What we're going to do now is record the transaction related to paying off all the cash accounts on account. So we have recorded the transactions increasing the accounts payable here. Now we're going to say what the transactions for us to pay off the accounts payable, which means we would credit cash to pay off the accounts payable, debit the accounts payable account for it. Again, we're grouping them all together basically in one type of transaction for the entire time period. We're going to do that by saying the accounts payable at the end should be $57,000. What is currently in accounts payable is $338,300. We want it to be minus $57,000, therefore transaction $3,326,000. So that's going to be our debit and our credit down here. If we record this out, let's see if it does what we would expect it to do, which is what we expect. We expect this accounts payable account to go down to the $57,000. So let's do that. We're going to post this out. And we're going to say then the cash is going to be decreasing, as we could see up top. The other side going to the accounts payable, that's the debit. It has a credit balance. We're going to debit it down to the $57,000. So now we're at that balance. Next transaction, this one is going to be related to this $27,000 here. We had a research expenses related to the development of student performance. Now in the past, we had grant money that said they would possibly give us from the government money to reimburse us for expenses related to some type of student performance type of activity. We're going to say that this $27,000 now qualifies for that. Therefore, we have spent $27,000 on something that the government has said that they would reimburse us for. So now we could say, hey, we've got a receivable for the grant money at this point in time, because now we've incurred the cost and therefore are qualified to get the money from the grant money. So now we can record the grant receivable, which we saw in a prior presentation when they said they possibly would give us grant money if we had expenses related to these items. We didn't have any expenses at that time. Now we have expenses we believe qualify for it, therefore can record the receivable related to that money. So we're going to debit the receivable for the grants receivable, and then we'll be crediting the revenues related to gifts and grants. So if we record this out, then we're going to say, all right, the grants receivable is an asset account. It's going to be going up in the debit direction by 27,000. The revenue, gifts, and grants is, of course, a revenue type of account. It's got a credit balance. It will be going up in the credit direction. The effect on the what would be similar to net income is, of course, increase to what would be the net income amount. Then we have the accrued liabilities paid. Accrued liabilities, if we look at our trial balance, is on the books at 44,000. Liability account, if we paid them, it's going to go down. We're going to pay it off with cash. So cash then going down. Cash is a debit balance. We're going to make it go down, doing the opposite thing to it, crediting it. This is a credit balance. We're going to make it go down by doing the opposite thing to it, debiting it. So if we see that, we're going to say, all right, then we're going to say the accrued liabilities was at 44,000. Credit, we debited it, making it go to zero, paying off the liability, and we paid it off with cash. Cash has a debit balance. We are going to credit it to make it go down. That'll put us back in balance. Note there's no effect on what would be similar to the net income number. Nothing happened to what would be like the income statement type of accounts in the dark blue. Next transaction, we have our adjusting entries. So the adjusting entries, starting with the depreciation. We're not going to go through the calculation of depreciation and all that kind of stuff. If you want to look into that, it's a topic in and of itself. We do have a course on depreciation. You can take a look at that. We're just going to simply record the depreciation here, similar to a for-profit type of organization. Recall that we have the capital assets on the books. We did not record them as an expense when we put them on the books because we weren't consuming them or using them at that point in time. We then put them on the books as an asset. We will then depreciate them or allocate the costs over the life of that asset in accordance with the matching or expense recognition principle to the accrual principle related to expenses. So what we're going to do then is record that depreciation expense now, and then record the other side to accumulated depreciation. So the depreciation expense is 65,000 debit, increasing the expense related to the allocation of the cost, the credit going to accumulated depreciation. Posting that out looks like this. We're going to say depreciation expense down below, going up in the debit direction. The accumulated depreciation is going to go up in the credit direction. We have a credit, we're crediting it. It then goes up in the credit direction. You'll note, of course, as accumulated depreciation goes up, the book value, the cost minus the accumulated depreciation, then goes down. Next transaction is we're going to be taking a look at and considering the allowance for doubtful accounts need to be adjusted to 19,000. That's going to be this account up top related to the accounts receivable. So the allowance for doubtful accounts is going to be that type of account that's going to be an estimate for how much of the accounts receivable we believe are not going to be collectible. If you want to think about how do we get to this number of knowing how much is not going to be receivables, it is an estimate. We have a course on that. You can take a look on that. It takes, to calculate that type of estimate with relation to the receivable. Here, we're going to say that determination has been made. The allowance should be 19,000. We're currently at 16,000. Therefore, we're going to need 3,000, the difference between 16 and 19, to adjust that up to 19. This is a credit balance account. We're going to credit it to make it go up. The other side here going to provision for bad debts, which is very similar to a for-profit type of organization when using the allowance method. So we're going to, instead of decreasing the basically revenue account, we're going to record kind of like a contra account, but it's going to be an expense account that is going to be increasing the expense account. So let's see what that will look like if we post it out. We got the provision for bad debt. That's going to be down here. It's going to go up in the debit direction, bringing down what would be similar to the net income. Then the allowance for doubtful accounts, this is going to be the contra asset account, going up in the credit direction to the 19,000, which we determined that it should be. As it goes up in the credit direction, it will bring down the net value of the receivables. Next, we're going to be taking a look at the 900, which is related to the accrued interest on investment. So the accrued interest on investments, we have investments. They have accrued interest. So we have basically some kind of income on it, possibly interest, possibly some other type of income has been accruing. We have not yet received it as of the cutoff date. Therefore, we have a receivable for it. So we're going to record the interest receivable that is owed to us, which we have not yet received. And then we have the revenues for the investment income going up in the credit direction. Posting this out, we've got the interest receivable going up in the debit direction. We have the credit for the revenues going up in the credit direction. This, of course, increases what would be similar to the net income number on the bottom line. Next, we'll be taking a look at the fair value of investment at year end. So here's going to be the investments. You can think about them basically investing, let's say, stocks that we have an investment in. They go up and down. We're saying that currently the stocks are at 280, our investments. Therefore, we want to increase this up to what the current value is. The difference between the 266 and the 280 is an increase of 14,000. Therefore, we need to increase the investment by the 14,000 to get it up to the 280. So we're going to debit the investment by the 14,000. The other side, revenue changes in the fair value. We've got to record the other side somewhere. So basically, we're going to say it's going to be some type of revenue kind of account. We're going to call it revenue changes in the fair value of the investment. Changes, so it might be a little bit different than the term you might see in a for-profit, which would be like unrealized gain. So if we record this out then, but the concept is basically the same. It's increasing in a credit direction in this case because it went up. So we're going to say investments are going to be up top. It started at the 266. We're going to debit it by the 14 to get to the 280. Then we have the revenue changes in fair value. It was at 0. It's going up in the credit direction to the 14,000. That, of course, increasing what would be similar to the net income number, the bottom line number down below.